Joining us now for a deeper dive into the jobs report is Miller Tabak, who is the chief market strategist, Matt Maley, and NatWest head of U.S., Michelle Girard. Great to have you all here with us today. You're both here with us today. First and foremost, want to get your reaction to the headline number that we saw come through, 428,000 jobs added, non-farm payrolls added during the month of April. Michelle, I'll go to you first.
Well, the job gain was not far off of expectations. We were at 400,000. The consensus was right around that same level. I do think, as you had said before the numbers were out, the most important piece of information for the markets was that hourly earnings number, that 0.3 of an increase month over month change was less than the consensus was looking for. It's less than the trend that we've seen. I think that will, while it is just 1 month, that will be very reassuring for the market in terms of the Fed not rethinking the message from yesterday, the main message, which is that 75 basis point increases are not something that are necessarily that the Fed sees as necessary right now. This backing off of the wage pressures to some extent, at least this month, would seem to keep that in check.
And Matt, it's Julie here. What does the market want? I've had a tricky time figuring this out this week, right? You had first this narrative that, the Fed took 75 basis points off the table. That's good news. And the market went up. And then the next day, the market went down because the Fed is still... that narrative doesn't make a lot of sense to me if you look at the market action. Like, what is going on?
Well, one of the things I agree with Michelle that this number this morning is kind of what was really what we wanted in a weird way, because we did, it's lower wage growth. That's good. But you didn't want really bad wage growth. You didn't want it too low because then it raised the specter of stagflation even more. When you got inflation going up and wages going down, people can't afford the higher prices. And that's a bigger problem. So this was kind of, the thing that really is I think, I see looking at the futures here on the side, they've rallied a little bit. And I think that's part of the reason. But overall, initially, as you mentioned, Julie, the 75 basis points being taken off the table, but what really changed? Not a whole lot. Inflation's still a problem, and it's going to be with us for a long time. A lot of people like to blame the Fed here for all our problems, but this war in Ukraine is really making a big impact. It's prolonging the higher food prices, higher oil prices. It's prolonging the supply chain issues, and therefore it's prolonging inflation for longer. Not necessarily something the Fed can control.
But Michelle, Michelle, I'll just let me play off Matt's point here. Do you think the market should be blaming the Federal Reserve? Because clearly they misread something Jerome Powell said on Wednesday, just given the market's reaction yesterday.
Yeah, I was gonna build off what Matt said as well. I will say, I do think that the Fed is a bit behind the curve. They probably waited too long, as did most central banks globally. But it isn't just even the war in Ukraine, which is exacerbating the supply-demand imbalance. Let's not underestimate also the impact of China doubling down on its COVID policies. I think that's a very big story in terms of the fact that is really hampering and hindering the supply that we're seeing out of China. And I think that is playing into very much the concerns that we have about global growth, but also about persistence of these supply and demand imbalances.
Matt, we had on the jobs front, we had a downward revision for total jobs for the past 2 months, 39,000 compared to previous estimates. Clearly, the economy is slowing down. Now, you take the economic slowing and you have rates going up maybe by 50 basis points the next 2 Fed meetings. Isn't that the worst possible backdrop for stocks?
Well, it's certainly not a good one. There's no question. Inflation is not, some people have said before that inflation, in previous months that inflation was good for stocks. Not really sure where they came with that. However, we also, the point is we're involved in a re-rating of valuations. Interest rates have moved up. That means that what would be considered fair value, a fair value for the overall stock market has to come down with it. And I don't know, the 18 times earnings, it probably has to come down some more. However, we've also seen some forced selling this week. This decline won't come in a straight line. I think we have further to go, but we're going to see some bounces along the way, just like we saw in the second half of March. And, if we get kind of a washout move, we kind of got a little bit of it yesterday, we could see a bounce soon. But again, this inflation issue is not going away.
Michelle, looking at some of the data, employment in leisure and hospitality, it's still down by about 1.4 million, 8.5% since pre-pandemic times, February 2020. Are companies at the wages that we've been discussing, are they even in a position to bring back the full workforce that was necessary?
Well, I think they are, although I do think that concerns about the health of the economy going forward may temper all of that. I mean, I think there are concerns that as a result of higher food and energy prices, there'll be less discretionary spending, and people will be less inclined to be going out to eat and engaging in a number of those activities that would be listed under the leisure and hospitality sector. So that might leave employers concerned about adding to a lot of staff going into this kind of environment. I think the other problem, of course, in that sector is just the lack of workers. And one of the aspects of the report you talked about before the report was released that came through was a bit disappointing was once again we saw the labor force participation rate tick down. If you look underlying the unemployment rate statistic, unemployment rate held steady. Underneath that, you saw a decline in the labor force as well as the number of people employed. Very volatile statistic, but again, we're looking very much at that supply of labor, and this month's numbers didn't really show us much improvement on that front.
And Michelle, to sort of come back to this idea that there seems to be this disconnect between Americans and the markets on what the Fed should be doing. Because if you look at consumer sentiment numbers, they are going down. There's a lot of consternation about inflation. Then you have Jay Powell saying, well, we don't really affect supply. We just affect the demand side of the equation. If the hottest part of inflation is in things like energy and food, is that the part of the demand curve that you need to affect? I guess I'm just struggling here. I feel like there's just a lot of dislocations right now.
No, you're exactly right, Julie. And you make a good point. I mean, I think the American people want inflation in check. Absolutely. They understand that higher inflation is as big a burden, quite honestly, as a slower economy. And they want the Fed to take the action necessary to ensure that prices don't continue to rise.
But that's what I'm saying though. Do they though?
No.
Do the American people want the Fed to cut rates and the slowing and the further economic slowing that will come with it? Because is the Fed's cutting at this point even actually going to affect things like energy and food, which are the most acute pain points for Americans right now?
Well, ultimately, we do need to get broadly demand down. So we do need to have a less stimulative policies. And a big way that the Fed's actions are going to work through to sort of curtail demand is through the financial channels. And in terms of, people are rightly saying that the reaction that Powell had to his statements on Wednesday, where the equity market went up, that you need a tightening of financial conditions to help to actually cool things down. So this is what, when he speaks, Main Street, let's say, welcomes the idea the Fed is going to be aggressive. The fact is that, higher bond prices, yields, and lower stock prices is one of the ways, while we don't, as investors, love that is an important transition mechanism for how Fed action is going to slow activity that will ultimately help to feed through to lower demand, therefore lower energy prices and food as well.
Matt, how concerned are you this week that we saw just a huge chunk come out of the market, and that may in fact lead to a consumer spending slowdown if these large volatile swings in the markets continue?
Yeah, that's certainly a concern. But I think Michelle makes a very, very important point here is that the people people don't like what's going on because it's painful. But I'm sorry to say, it's needed. Okay, the Fed pushed asset prices way higher, well above their underlying fundamental values by keeping that their liquidity, their liquidity spigots wide open longer than they should have. They kept the emergency level of liquidity long past the emergency. So I'm sorry, but those levels, those asset prices, have to come back down to be more fairly valued. That's a painful thing. So people want their cake and eat it too. They want to have lower inflation, and they want to have the economy and asset prices to hold up. I'm sorry, that's just not going to happen. We're going to have to go through the pain now, and that will be very good and very bullish on a longer term basis, and will create a great buying opportunity at some point later this year. But I'm afraid it's going to have to be painful right now.
Yeah, it was certainly painful yesterday, Matt, and that cake was taken right out from under the noses and mouths of investors. But let me quickly recap these numbers. Non-farm payrolls in April rose by 428,000. The unemployment rate remained unchanged at 3.6%. Also unchanged was the average work week. We also saw downward revisions to the prior 2 months of 39,000, something to keep in mind. But coming up, we'll continue our conversation with Michelle Girard and Matt Maley. Don't go anywhere.